We are told that the banking industry is stronger than ever before, but the IMF just issued a banking warning that you might want to pay attention to. The IMF, the International Monetary Fund, just released a report where they said banks in the US and UK are overly exposed to private credit institutions. Why does that matter? Because we're starting to see a rise in defaults in those private credit institutions. These credit agency defaults are starting to hurt banks, and if these defaults continue to rise, it could create a domino effect in the banking industry, which is what the IMF is warning about. So let me explain what's going on. The IMF helps to monitor the global economy, and they recently published their Global Financial Stability Report. And let me read you one sentence from the report. Beneath the calm surface, the ground is shifting in several parts of the financial system, giving rise to vulnerabilities. What are these vulnerabilities that they're talking about? Banks in the United States and the United Kingdom have $4.5 trillion worth of exposure to hedge funds, private credit groups, and other non-bank financial institutions. A NBFI, a non-bank financial institution, is not a bank, but they kind of act like one. They lend money to people, they're the hedge funds, the credit institutions, the lenders, but they're not regulated the way the banks are. And the way that it works is that banks provide funding to these NBFIs, the non-bank financial institutions, that then go out and lend money to people, like this guy with the mustache right here, or this lady with the nice braid right there. So what the IMF is saying is that banks are becoming overly exposed by lending a huge chunk of their assets to these non-bank financial institutions, which normally is not a problem. But the reason why they're saying it's becoming a problem is because we're seeing an uptick in bankruptcies with these non-bank financial institutions right here. For example, very recently, Tricolor, which is the subprime auto lender, declared bankruptcy, and then not too long after that, the First Brand Group also declared bankruptcy with billions of dollars of loans that, quote, vanished. And there are three reasons why this is concerning according to the IMF. Number one is the sheer amount of exposure that banks have to these non-banking financial institutions. The IMF warned that banks across the US and Europe have roughly $4.5 trillion of exposure to NBFIs. The reason why the IMF says that's concerning is because if we start to see an uptick of defaults here, they're concerned that banks are not going to have enough protection to cushion them against all those defaults. Take a read. Lenders with non-bank exposures worth more than their capital now represent more than 40% of total banking assets. What that means is that 40% of total banking assets that are invested in these NBFIs are sitting in banks that if these were to default, they don't have the money to cover these losses. That's why the IMF is concerned that if these defaults rise, we're going to see banks default as well. The second reason the IMF is concerned has to do with regulations, or should I say the lack of regulations here as opposed to here. Because if you go and borrow money from a bank, there's a lot of regulations that banks have to follow. But because these NBFIs don't actually take deposits, they're not an actual bank, they don't have to have the same regulatory requirements that banks have, so they can make riskier loans. Take a read. Hedge funds have rejected recent calls for tighter scrutiny, saying they use less leverage than banks and do not benefit from taxpayer-backed deposit guaranteed systems. So we've been seeing a big growth in these intermediaries, the NBFIs that are issuing the loans, but they're not banks. And because they're not banks, they don't have the same rules and requirements that banks have, which means they can make different lending practices than banks might because they don't have the same rules, the same scrutiny. And this is where the IMF says this could create problems because if they're issuing a lot of loans to make some quick money and they start to default, it not just creates a problem for them, but because they're funded by these banks and these banks are overly exposed here, it can start to create some more problems. And this brings us to number three, money and incentives. You might be wondering, if these are riskier, and if this is risky for the banks, why would people want to make these loans and these investments? And it's because of the profit potential, because they've been making a lot of money through this. There's a lot of high returns, and so banks like it because they've been getting paid big returns, and these people like it because, well, they're also making these big loans, and they're getting paid too. Take a read. The overall trend here is that in the search for yield, there's been a lack of care around underwriting standards. Did you catch that last part? Let me read it again. There has been a lack of care around underwriting standards. The NBFI wants to make money, so they are issuing more loans. Banks want to make money, so they're funding the NBFIs, and they don't want to miss out the big opportunities, so they keep funding the NBFIs, and this is where IMF says they might be getting a little overexposed because they're investing more money that they can lose. The NBFIs don't want to miss it on the lending potential, and the big growth potential, and the big profit potentials, so they keep making the loans, and they don't have the same regulatory requirements that banks have. And this is where the IMF says that there could be some issues. For example, when Tricolor declared bankruptcy, that was about a $200 million loss directly to Fifth Third Bank. Now, before I get into how this creates opportunity and what this means for you, I do want to remind you that for those of you that are investors or want to become investors, I have put together a brand new free investing masterclass where I walk you through how you can get started as an investor and find hidden investment opportunities before everybody else. And I'll also show you the exact framework that my firm and I use to research investment opportunities and find opportunities before they hit the headlines. It's a completely free masterclass. There's a ton of value in this masterclass. So if you want to get the masterclass, all you have to do is register, and I have the link for you down in the description below. And as an added bonus, when you register, you're also going to get access to Market Briefs, which is my newsletter for investors, completely for free. So if you want to get the masterclass and Market Briefs, all you have to do is click the link down in the description. I want you to read this one sentence from Financial Times, which helps put this all into perspective. Banks are increasingly lending to private credit funds, NBFIs, because these loans often deliver higher returns on equity than traditional lending, thanks to the lower capital requirements allowed by the collateral structure. So the reason why this is happening is because of the big profit potential, but it also comes with big downfall potential. Read this. The worry is that if we were to enter into a more pronounced downturn, there would be more redemption pressures on these retail products. So yes, that is a first order concern. Meaning if we start to see more defaults here, two things are going to happen. Number one, we're going to see more pain on the bank side, but then you're going to see more of these investors say, you know what, we want our money back. And these institutions are then going to struggle because they might be forced to pay money that they don't have, which could trigger a domino effect, hurting these institutions and these institutions. And what we've seen throughout history and in 2025 is that when the money gets tight, that's when the fraud and the bad loans start to come out, because when everybody's making money, they don't really start to look for the problems. So the thing you want to pay attention to, number one, is what's causing the change. And the change is happening because of none other than higher interest rates. And I know that the Federal Reserve Bank has cut interest rates a couple of times in 2025, but interest rates are still generally higher today than where we were a few years ago. And these higher interest rates are contributing to higher loan pressure for the borrowers here. And so when you have riskier loans with higher interest rates, with still inflation, with a slowing down economy, with a slowing down job market, some people cannot pay back those loans. And if these are the riskier loans and they cannot pay their money back here, like we saw happen with the default in subprime loans and other subprime car loans, that hurts these NBFIs. So the higher interest rates are making it harder for certain people to pay the loans, particularly people that are struggling in this tougher economy. If we start to see more defaults here, that can obviously hurt these industries, but it can also hurt the banking industries. So the question is, what does this mean for you as an investor? And number one is expect volatility through talks about interest rates and through talks about defaults here. If we start to see more defaults here, expect more volatility, period. When it comes to opportunity, the name of the game is explained by Warren Buffett. Be fearful when others are greedy, be greedy when others are fearful. So when people are freaking out and selling out of certain stocks, that creates an investment opportunity for the financially savvy, assuming that you're buying good investments at a discounted price. So if we were to see more concern here, if we were to see more defaults here, we could see a panic in certain stocks, particularly banks who have a lot of exposure to these NBFIs. But not every bank does. And you would probably see the good banks also get hurt, because if part of an industry is getting hurt, pretty much every stock in the industry gets hurt because people panic, they sell, and they don't know what's happening because we get very emotional. That can create opportunity for financially savvy investors to come in and buy good investments at a discounted price. So it could create opportunity at the bank level. If you're interested in investing in individual companies, it could also create opportunity if this has a more widespread effect to invest into broader markets. I mean, there are funds out there to give you exposure to the S&P 500. That's the 500 largest companies in the stock market. There are funds out there to give you exposure to banking stocks. There are funds out there to give you exposure to pretty much any type of group of stock that you want. And if you see a downturn, well, people generally run away, but that also creates investment opportunity for the financially savvy who will go against the grain and who can look for the opportunity when other people are running away. Because the reality is more millionaires are made during recessions and market crashes than any other time. The reason why is because when you have that downturn, good investments go on sale. People want to sell because they're scared that the whole world is going to end. But that creates opportunity for financially savvy investors who have money, who have the financial education, that are prepared to come in and buy. And well, we've seen that happen time and time again in the past. In 2022, when the stock market fell by 20%, people were running away, but financially savvy investors were buying stocks at a discounted price. In 2020, when the markets fell by 35%, many people were running away and panicking. The financially savvy investors were coming and buying. In 2008, when the housing market got slashed, when the old stock market was tumbling, financially savvy investors were coming in and buying while most people were running away. In 2000, when the dot-com bubble burst, people were running away saying that the internet was a fad, the internet is over, it's never going to be a real thing. But the financially savvy came in and they were buying. Again, you can pick your level of exposure. You can come in and buy individual companies, which is the most risk for the most potential return. Now you really have to know how to analyze companies, you have to know how to research companies and pick good companies, or you can invest in broad basket funds, which has less work, less risk, and now you just ride the wave because you know markets go through cycles. Now you don't want to go in and just try to time markets, that's not what I'm saying, but it's good to have some money on the side that will, when things go wrong, you can be prepared to capitalize on those opportunities, because there's a lot of interesting things happening in our economy right now. We have this concern about the IMF. We have concerns about trade wars. We have concerns about inflation. We have concerns about the economy slowing down. We have concerns about AI taking jobs during a time where every asset class, stocks, real estate, gold, crypto are all near record highs. So it is a very strange economy. We have concerns about the dollar. We have concerns about inflation. We know that recessions happen. We know market crashes happen. They've happened every decade for the last century. It's a matter of when, not if. And a lot of people panic and freak out when you say that, but the reality is we're going to see another recession, we're going to see another market crash. Now when you understand that, you don't have to be freaking out about it, you can understand it's just a part of our economic cycle. Now when you understand that, you just want to be prepared. Because when it happens, whether it's in 6 months, 6 years, or in 10 years, you can be ready. And you can be ready to capitalize and build wealth, because these downturns create opportunities. Now again, I'm not saying that you need to wait for a downturn to invest your money, but they create great investment opportunities for you to come in and buy good investments at a discounted price. You need to know what your investing strategy is. That way you can find the best opportunities, but just understand that when you have volatility, when you have economic pain, it also creates opportunity for the financially savvy. Again, if you want some more resources on how to be a better investor, I have my investing masterclass for you down in the description. And if you got value out of this video, the best thank you is a referral. So if you could, please share this video with a friend, family member, colleague, or fellow investor so we can continue to spread this financial education. Thank you. It is getting harder than ever for the average person to get a job and build wealth, because traditional entry-level skills are now being automated by AI. But this is the silver lining, because for those of you that are go-getters that want to go the extra mile, this shift is going to create more millionaires than ever before. And yes, the things that I'm about to show you will apply whether you work a job or run a business.